One company owns a piece of almost every stock you've ever heard of. It votes on behalf of shareholders at thousands of corporations simultaneously. It advises the Federal Reserve, the European Central Bank, and the Bank of Canada. It built the software that manages risk for more money than exists in most countries, and almost nobody outside of finance knows its name. That company is BlackRock. Larry Fink grew up in Van Nuys, California, the son of a shoe store owner and an English professor. Nothing about his childhood suggested he would one day control more wealth than any single human in history. He studied political science at UCLA, not finance. He wasn't the sharpest student in the room, but he had one quality that would define everything that followed. He understood risk before anyone else did. In 1976, Fink joined First Boston, a Wall Street investment bank. As a junior trader, he was 23 years old, earning $42,000 a year and watching older men make millions on instruments he barely understood. He asked questions they found annoying. He built spreadsheets they found obsessive. He stared at mortgage data while his colleagues played golf. By 1986, Fink had built the mortgage-backed securities desk at First Boston into a machine generating hundreds of millions in profit. He wasn't just trading bonds, he was slicing and repackaging home loans into financial products, then selling those products to pension funds, insurance companies, and banks across America and Europe. He was, by any measure, one of the most valuable people on Wall Street. Then, in 1986, a single interest rate miscalculation cost First Boston $100 million in a single quarter. Fink's desk, Fink's model, Fink's stake. He wasn't fired, but something shifted. How does a man who just lost $100 million in 3 months go on to manage $10 trillion? That question matters because the answer tells you everything about how modern finance actually works. In 1988, Fink co-founded BlackRock out of a single room inside the Blackstone Group's offices in Midtown Manhattan. He had 7 partners, 0 clients, and one idea: that every investment decision should be built on understanding risk first, return second. The timing was not accidental. America's pension system was quietly breaking. Millions of baby boomers were approaching retirement. Defined benefit plans were being replaced by 401k accounts. Ordinary people were suddenly responsible for their own financial futures, whether they understood markets or not. Someone needed to manage that money. Someone needed to be trusted with it. BlackRock raised $50 million in its first year. Within 4 years, it was managing $17 billion. The secret was Aladdin. Aladdin, which stands for Asset, Liability, Debt, and Derivative Investment Network, was the proprietary risk management software Fink's team built from scratch in the early 1990s. It could analyze thousands of variables simultaneously, stress test portfolios against historical crashes, and flag vulnerabilities that human analysts would never catch. By 1994, Aladdin wasn't just running BlackRock's money. Other firms were paying to use it. By 2000, it was processing data on $1 trillion in assets. By 2020, that number had reached $21.6 trillion. Today, roughly $1 in every 10 managed professionally anywhere on Earth passes through Aladdin's calculations. One piece of software, built by one company, quietly became the nervous system of global finance. But Aladdin was only half the story. In 2009, BlackRock made the acquisition that transformed it from a large asset manager into something with no real precedent. It bought Barclays Global Investors for $13.5 billion. Inside that deal was iShares, the world's largest provider of exchange-traded funds. ETFs are simple instruments. They track an index like the S&P 500 and allow ordinary investors to buy a piece of the entire market for a fraction of the cost of active management. iShares already had $1 trillion in assets under management when BlackRock absorbed it. BlackRock now had everything: risk software that managed the world's institutional money, and the product that was quietly replacing traditional investing for tens of millions of individuals in the US, UK, Canada, and Australia. Assets poured in. By 2017, BlackRock managed $6 trillion. By 2019, $7.4 trillion. By 2022, it crossed $10 trillion. But something more significant than the numbers was happening. Because iShares is a passive investor by design, BlackRock doesn't pick stocks. It buys everything, which means BlackRock became the largest or second largest shareholder in Apple, Microsoft, Amazon, JP Morgan Chase, ExxonMobil, and thousands of other companies simultaneously. Think about what that means for a moment. The same company that owns a major stake in Coca-Cola also owns a major stake in Pepsi. The same company that holds Boeing also holds Airbus. The same company sitting on the board of Goldman Sachs also has a seat at Morgan Stanley. In 2019, 3 professors at the University of Amsterdam published research suggesting that common ownership of this kind, where one entity holds significant stakes in competing companies, reduces competition. Prices stay higher. Innovation slows. The incentive to undercut a competitor disappears when the same investor profits from both. The research was contested. The implications were not dismissed. The fall, when it came, wasn't a collapse. It was a reckoning that arrived slowly, then all at once. In 2022, rising interest rates hammered bond markets globally. BlackRock's own funds lost billions. Its iShares bond ETFs dropped in value for the first time in over a decade. Millions of retail investors, who had been told these were low-risk products, watched their savings shrink. A 65-year-old retired teacher in Ohio who had put $180,000 into a BlackRock bond fund on advice from her financial planner lost $31,000 in 8 months. She wasn't alone. She was one of millions. The losses were legal. The products had disclosed their risks. But disclosure and understanding are different things, and BlackRock knew that better than anyone. Meanwhile, the political temperature around the company had been rising for years. In 2022, Republican-led states, including Texas, Florida, and West Virginia, began pulling state pension funds from BlackRock. The stated reason was BlackRock's ESG, or Environmental, Social, and Governance, investing framework, which directed capital away from coal, oil sands, and certain firearms manufacturers. Texas estimated the policy could cost the state $668 million over 10 years in higher borrowing costs. Larry Fink, who had championed stakeholder capitalism in annual letters to CEOs since 2018, suddenly became a political target. Fink stopped using the term ESG publicly in 2023. He said the phrase had been, in his words, weaponized. The strategy itself quietly remained, but the public face changed. That change told you something. When the most powerful investor in the world adjusts his vocabulary based on political pressure, the market and democracy are no longer operating in separate lanes. Today, BlackRock manages approximately $11.5 trillion in assets as of early 2025, following its $12.5 billion acquisition of Global Infrastructure Partners in 2024. That deal gave BlackRock control over airports, pipelines, and data centers across 4 continents. Physical infrastructure, not just financial instruments, actual roads, actual ports. The European Union has opened preliminary inquiries into whether firms like BlackRock exercise too much influence over capital allocation across member states. The IMF has flagged concentration risk in asset management as a systemic vulnerability. The SEC has spent years debating whether BlackRock should be classified as a systemically important financial institution, the same designation given to banks considered too big to fail. None of these processes have produced binding outcomes. The retired teacher in Ohio has recovered some of her losses. Others haven't. The Aladdin platform now processes data on $21.6 trillion in assets every single day, including the portfolios of central banks and sovereign wealth funds who use it to manage national reserves. Larry Fink, now 72, is still the chairman and CEO. The company he built from a single room in someone else's office in 1988 now influences the price of your groceries through commodity funds, the value of your home through mortgage-backed security markets, the stability of your pension through its dominance in fixed income, and the performance of your retirement account through iShares products you almost certainly own without knowing it. There was no fraud, no crime, no villain in the traditional sense, just one man who understood risk better than everyone else, at exactly the moment the world decided to hand its financial future to whoever could manage that risk most efficiently. The question that nobody has answered yet is a simple one. What happens when the company that manages the risk is itself the risk?